Hi, everybody. Thanks for watching. I wanted to make a video today about silver buying strategies and several different types of investors and ways to buy in, sell, trade over the long run, medium term, whatnot. Different strategies essentially on how to invest. Yeah, ideally, in every commodity we invest in works as simply as buy low, sell high. But in reality, we know that often people buy in the middle and sell somewhere close, sometimes higher, sometimes less. By close, I mean with spreads no greater than, I don't know, like plus or minus 35%, which can be significant. Like buying silver at $30 an ounce and selling off when it's $20 or $40, for example. Just an example. At least in modern times, this seems to be normal for people I've encountered. I've encountered plenty of people that have had this happen to them. Is there a secret trick to buying silver? A way to know if it's about to collapse or conversely skyrocket? I don't think so. There are general truths to predicting the market, such as the prevailing economic conditions, the volume of available supply, the saturation of speculators in the market, etc. But to know if in 15 seconds spot will be up or down is irrelevant for anyone, uh, any medium or long term investors. And really, it's kind of absurd to really speculate about in 15 seconds, unless you're a Wall Street floor trader. So, what strategy to buying works best? If we can't know what silver will be in an hour or day, how do we know when to buy or to sell? Maybe collapse really is right around the corner. I've heard, whoa, I've heard a cornucopia of input on this subject. I met a dealer in Florida who said his idea was to simply buy all the time. Take $100 or $300 a week or month, set it aside, and buy as much silver as you can with that money, whether it's up or down. He reasoned that you would be buying in at the moving average, which the lows should cancel out the highs and vice versa, leaving you in the positive somehow. The problem with this logic is that inherently, if you are a believer in silver being a bellwether for inflation, which I'm not sure if that's entirely accurate, supply changes almost as much as demand, then you're not making any net profit over the long run. If this practice was kept up for a decade or two, enough to last a recession and an expansion of the economy, which would make silver worse than many other investments whose goal is to increase your net wealth over time, not flatline or stagnate, inflation adjusted. If you accept mediocrity for an investment strategy, that's your business. Personally, I think this idea of buy constantly is nonsense because as long as there are alternative investments, many of which, if you research, can be found to have precious metals backing as an ultimate fallback, if that's your fear, then this particular strategy is useless and really irrational. This all assumes that silver can be held to be a source of constant value, external of nominal figures, or essentially an inflation proof asset, which it isn't. It's simply a good indicator of financial and economic turmoil and fears. Viewing this strategy from the lens of silver being what it truly is, a commodity constantly being mined, being speculated on, driving prices up, not from industrial demand, but from investors who want to make a quick buck, and also being used in jewelry, certain medical and electronics field uses, and elsewhere. It's perpetually in a state of change, silver is. No precious metal represents an absolute value, not gold, not silver, or any other. They're simply good signs of market behavior. And whether people are fleeing from investing in actual businesses or are flocking to them, and for the latter reason, if they have any holding in precious metals, they often will liquidate them for the cash they need, which, if enough speculators do this simultaneously, can cause a silver crash. Hence the reason to avoid buying in during a speculator saturated market run. So, to the point, if silver truly is in a perpetual state of change in terms of value, then buying constantly ignores the greatest detractor to a moving price point investment. Eventually, every investment reaches a point to liquidate, and at that time, whenever it may be, the price per ounce sold for then may not be the same or more than the average price per ounce of what was paid for the silver, turning your personal wealth into something as volatile as the metal itself. For every 20 or 30 years that goes by, silver only spikes dramatically, quite briefly, a weekend, a few days, that's it. Typically, a year or so, it'll be in a general uptrend, and then it falls back in on itself. a year or two. That means if you have ever had to sell for medical reasons, or maybe you die and your children don't care much for bars of a metal, that out of every 30 years, less than about 3 of those years have a statistically above average rate for silver spot, meaning you have a 90% chance of trading sideways or even at a loss. Although if you're dead, I'm not sure you wouldn't care much. There aren't many merits to moving average strategy. If you can think of one, leave it in the comments below. In the meantime, consider what strategy you have on silver and whether anything you've heard here, even if you don't partake in the moving average strategy, has influenced your thoughts on when to buy and when to sell. Thanks for watching. So I wrote that paper out because I met this dealer who had this interesting idea of how to invest. And I'm not going to tell people how to invest, but I have ideas on how to invest. And I like to exchange ideas. And yes, I will criticize bad ideas and I will bolster good ideas. But I mean, that's how the great ideas win out, is by a challenge to ideas. If you don't challenge it, then how can you ever substantiate it? Anyway, if you can defend it, go right ahead. Thanks for watching. Thanks for challenging. Goodbye.